It began before dawn in Chicago. A cooling system failure inside one of CME Group's data centers triggered a cascade of technical issues. Automated trading systems halted. Liquidity dried up in an instant. Futures on equities, currencies, bonds, and commodities, from the S&P 500 to gold to crude oil, all froze simultaneously. Around the world, traders and analysts watched prices pause mid-tick, a rare event in markets built on microseconds. In London, trading desks grew silent. In Singapore, brokers scanned for backups. In New York, the financial lifeblood of futures markets seemed to evaporate. CME Group, founded in 1898, and today responsible for trillions of dollars in market activity daily, had suffered a rare operational breakdown. And for nearly 11 hours, global markets flew blind. To understand why this mattered, you need to understand what CME actually is. CME Group isn't just another exchange. It is the global engine of price discovery, a network where expectations about the future are constantly recalculated and broadcast to the world. Its markets determine how currencies are priced, how commodities are valued, how interest rates are hedged, how stock markets open each morning. CME futures are the first signal investors receive about where the world economy is heading. Every major bank, hedge fund, pension fund, central bank, importer, exporter, airline, energy company, and food producer interacts with CME prices in one way or another. A halt at CME doesn't just pause trading. It pauses information. It pauses expectations. It pauses the world's ability to hedge risk. When the outage occurred, there was no live signal for crude oil futures, no benchmark for Treasury futures, no real-time guidance for equity indexes. Suddenly, markets dependent on CME quotes, countless other exchanges, brokers, clearinghouses, found themselves unable to process reliable data. For an economy built on constant streams of information, silence is dangerous. Modern exchanges operate inside some of the most advanced technological environments on Earth. Data centers with redundant power, fiber networks, backup servers, climate control systems, and security that resembles a government facility. But like all complex systems, they have vulnerabilities. According to CME's initial statements, a cooling system malfunction inside a core data center forced protective shutdowns to prevent permanent hardware damage. In high-density server environments, cooling is critical. Temperatures can climb dangerously within minutes. Once servers go offline, restarting them isn't as simple as flipping a switch. Exchanges must ensure correct sequencing, synchronization, and integrity checks across millions of data points before reopening. This is why the outage lasted nearly half a day, a massive period in markets calibrated to operate 23 hours a day, 5 days a week.
As the downtime extended, the world was forced to confront a difficult truth. Even the most advanced financial systems are not invincible. In London, analysts at major investment banks paused their early morning risk models. European index futures, which rely heavily on CME benchmarks, lacked the reliable price feeds needed to calculate exposures. In Asia, traders who had positioned themselves for overnight news, from corporate earnings to geopolitical developments, suddenly couldn't adjust their positions. Some hedge funds temporarily halted automated strategies. Others scrambled to access alternative markets. In the United States, brokers and clearing firms issued notices to clients. Markets were halted due to a CME technical issue. Without futures data, stress spilled into related markets. Investors questioned how to price risk. Liquidity on other exchanges thinned. The coordinated rhythm of global trading fractured. This wasn't just a technical failure. It was an economic pause button. Market outages aren't new, but outages of this scale are extremely rare. In 2013, the Nasdaq halted trading for 3 hours due to a connectivity glitch, raising concerns about technology concentration in equity markets. In 2015, the New York Stock Exchange shut down for nearly 4 hours because of a software issue. But those events, disruptive as they were, involved individual equity markets. What happened at CME in this outage struck deeper because CME underpins global derivatives, not just stocks. Its futures markets influence everything from airline ticket prices to food costs to central bank decisions. This outage was historic because it disrupted a core artery of global financial stability. To understand the full impact, imagine the ripple effect. When crude oil futures freeze, energy companies can't hedge price risk for shipments. When Treasury futures stop, global bond markets lose a key benchmark for interest rate expectations. When equity index futures stall, stock markets open with uncertainty and volatility. When currency futures halt, exporters and importers can't secure exchange rates for cross-border deals. Billions of dollars in risk exposures remained unprotected during the outage. Traders described the feeling as flying with no instruments. Outages don't just affect Wall Street. They affect farmers hedging grain prices, airlines managing jet fuel costs, and manufacturers protecting currency exposure. This outage revealed how deeply the world relies on CME's continuous operation. From the moment the outage began, CME's leadership faced intense scrutiny from regulators, institutional clients, and the media. CME Group CEO Terry Duffy issued statements confirming the source of the problem and emphasizing that the shutdown was a protective measure to prevent hardware damage. Restoring operations safely required careful system checks, data validation, and coordination with clearing partners. By late afternoon, trading slowly resumed, but global markets had already spent hours operating without one of their most important sources of information. Regulators requested detailed reports. Analysts questioned resilience planning. Institutional traders demanded stricter redundancy protocols. If the outage revealed anything, it was this: market infrastructure, once considered nearly indestructible, is more vulnerable than we imagine.
The outage triggered a larger conversation about systemic risk. In finance, the concept of single points of failure is well known. But CME is not just another node. It is a concentrated pillar of global price discovery. Studies from central banks and financial stability councils have long warned that as markets become more interconnected and automated, infrastructure failures create amplified risk. When one exchange goes down, it doesn't affect one market. It affects all markets connected to it. Derivatives markets rely on real-time data pipelines. Clearinghouses rely on exchange connectivity. Banks rely on accurate pricing. Risk models rely on live inputs. One malfunction can cascade into global uncertainty. And during this outage, that cascade was visible. The modern financial system is fast, incredibly fast. Algorithms react in microseconds. High-frequency traders transmit thousands of messages per second. Liquidity is constantly shifting. But speed comes at a price. It demands complex infrastructure. And that infrastructure increasingly sits inside a few enormous organizations: CME, ICE, NASDAQ, NYSE, together control the backbone of global capital markets. Centralization brings efficiency, but also risk. A failure in one of these systems can ripple across the world in minutes, as this outage demonstrated. The question now is not whether technology can fail, but how often and how prepared we are. In the aftermath, CME began reviewing its redundancy architecture, temperature management systems, and backup data center protocols. Regulators are assessing whether additional oversight is needed for critical financial infrastructure. Institutional clients are demanding greater transparency into exchange resilience. Some are exploring multi-exchange routing solutions to avoid concentration risk. Others are developing internal contingency plans. But the deeper question remains unanswered. Can global markets maintain stability in a world where infrastructure is massively complex, yet increasingly centralized? The outage was a wake-up call, a reminder that financial stability depends not just on banks, central banks, or investors, but on the invisible infrastructure that powers markets each second of every day. It highlighted three lessons. First, technological resilience must evolve as quickly as the systems it protects. Second, transparency strengthens trust. Markets need clear communication when failures occur. Third, diversification and redundancy aren't luxuries, they're necessities. If anything, this event showed that the modern financial system is only as strong as the data centers that keep it running, and that even a cooling unit failure can shake the world. The CME outage will not be the last of its kind, but it may be the one that forces the world to prepare better. Global finance is an intricate web, woven through time zones, technologies, institutions, and billions of daily decisions. The CME outage revealed how interconnected, interdependent, and vulnerable this web has become. Markets can survive volatility. They can survive uncertainty.
What they cannot easily survive is silence. In a system built on information, the absence of information is the true threat. The outage ended. Markets reopened. Prices moved again. But its impact remains, reshaping how we think about resilience, risk, and the future of global markets. Because sometimes it only takes a single failure to reveal the strength or the fragility of the world we've built. This was the outage that shook the world.